Today, the Bank of Canada gave its final rate announcement of 2025. That's right, December 10th, 2025. The Bank of Canada announced that they are not making any changes to their interest rate. They've dropped several times this year, which has been fantastic. Variable interest rates are available between 3.5% and 4%. Fixed interest rates are currently between 4 and 4.5% if you're looking for a 3, 4, or 5-year term. Now, what happened? Because a lot of people were thinking that we would see an interest rate cut not only back in October when we did, but again here in December. And if not in December, here in the new year right away. But that messaging seems to have changed. No rate change today became widely anticipated. All of the media was talking about that. All of the economists were talking about that. I think the market was predicting maybe a 6% chance of a rate cut today. And the market predicted correctly there was no rate cut. Now, what's changed is the messaging around whether or not there will be any more rate cuts. A lot of economists were thinking that in early 2026, in the first quarter, maybe the second quarter, we would see another rate cut. The only bank economists that were thinking otherwise was Scotiabank, who instead was predicting no more rate cuts and a few increases in the last half of 2026. Now, why did that change? Well, it actually comes down to the GDP and more specifically, the jobs data that was released last week. Over the last 3 months in Canada, the headline number shows that we've seen about 180,000 new jobs created, which at first glance is really great until you realize that 93% of those were part-time jobs for people aged 15 to 24 years old. Those aren't the people that are driving the economy, like great people for sure, right? We were all there at one point. But those aren't the spenders. Those aren't the people paying rent. Those aren't the people paying for mortgages. Those aren't the people spending the money in our economy. If we take a look at full-time jobs, we've lost 18,000 full-time jobs. So lifting up the hood, looking a little bit underneath the headline shows a much bleaker picture than the headline actually shows. So this is a case where the headline looks strong, but the details themselves, they're just weaker. Good news is bad news is good news, right? This good news of headline number of the more jobs is bad news for interest rates. If the economy is doing well, we're not going to see interest rate cuts because the economy doesn't need stimulus. Those of us who would prefer lower interest rates, but are otherwise gainfully employed, making enough money, doing okay, we like it when the economy is a little weaker, needing lower interest rates. However, most of us overall do better when the economy is stronger, right? A rising tide raises all ships. But that also means we have a bit higher interest rates to contend with. So this data is showing good information, at least on the headlines, but likely it's not as good of information. So we can still optimistically hope for another rate cut probably in the first half of next year. The Governing Council of the Bank of Canada has said that they see the current policy rate at about the right level to keep inflation close to the 2%. They're not eager to start increasing interest rates. They're going to continue to look at the data as it evolves and becomes more available to determine if another interest rate cut is necessary. A lot of these jobs that were part-time created could just be a seasonal effect, right? We have Christmas and the holiday season coming up, so a lot more retail needs, a lot more delivery. The Amazon warehouses, they really staff up this time of year. So we'll see in January and February what's actually happening with that. Now, what the Bank of Canada said is important. Okay, they acknowledged improvement, but with caution. They say that growth has been uneven and volatile. Hiring intentions remain subdued, and trade-sensitive sectors are still weak. Here's the Bank of Canada. They say employment has shown solid gains. Nevertheless, economy-wide hiring intentions continue to be subdued. So the bank isn't panicking over these headlines. They're going to take a look and see what happens with the data as more of it becomes available over the coming months. Inflation, it's close to its target, right? We are down to 2.2%. The bank's target is 2%, but core inflation, that's another way of measuring inflation that the Bank of Canada likes to use. It's still trending closer to the 3% mark. And there's expected to be some noise on inflation here in the coming months. Looking through the choppiness, the bank expects ongoing economic slack to roughly offset cost pressures. What does that mean? They're expecting some weakness in the economy to offset increases in prices or pressures of increasing prices, which would help it not have the inflationary impact. Inflation isn't gone, but it's not running away from us either. Now, in the last little while, we have seen some fixed rates start to move up. A lot of that is because of international activity. And we've seen fixed interest rates rise about 0.25%. As of right now, variable rates are about 0.5% lower than fixed rates. So if you're making the choice of whether or not to renew your mortgage into a fixed versus a variable rate, or if you're looking at purchasing a home and you're choosing between a fixed or a variable rate, the truth is it's kind of a coin toss. The models right now are showing that a 5-year fix may be a little bit better by a couple $1,000s over the next 5 years when compared to going variable over the same 5 years on, say, a $300,000 mortgage. That said, there is opportunity to potentially save by going variable. So if you have the ability to handle some changes either in payment or in the amount of interest rate or interest that you're going to pay, and it's not going to keep you up at night because you're so stressed about your interest rate, then variable does provide an opportunity there. But if you're going to have a terrible 5 years because you're always nervous about what might happen next week on your interest rate, maybe paying a little bit more right now and possibly a little bit less than you would later on in your 5-year term and going fixed today at about 0.5% higher than variable may be the right choice for you. Personally, I'm staying in a variable rate mortgage. I'm around 3.5%. On that, I could have locked in around 4%. I've chosen not to do that. And I can handle a little bit of change, but that's not everybody's reality. So it really does depend on you and what you need. If you are in the middle of having to make this decision, if you're coming up for a mortgage renewal, or if you're looking to buy a home, please reach out to me or my team. Contact information or access to our website is available in the description for this video. And I am looking forward to talking to you. Absolutely want to help you out with this as you navigate this. And you know what? The answers are different for everybody. So that's where having an expert like myself or my team talk you through it and help you make that decision can be very helpful. Thanks for watching, and I'll bring you more of this next time.